Hello and welcome to NDTV Profit. You are watching a special show. We are calling it the big IT comeback. And frankly, if you look at the way the stocks have moved up, it is indeed a big IT comeback. With me is Sajid Mangat. And Sajid, it is astounding to see that the IT index at large has had the biggest gain in the last 6 months. The stock of TCS has not seen such a gain in 42 months. It is clearly big IT comeback. And if TCS has done this and if others follow suit, it could well be a very interesting next 6 to 9 odd months, because globally too, I was reading this morning that a lot of people are going into this earnings season globally with very positive and upbeat outlook for the chip manufacturing stocks. Of course, these are different, but largely falling under the tech bucket. But I just thought it was astounding to see what's happened as a market reaction to this, because last point, it's not something that has happened out of the blue. Since Accenture numbers, these stocks have rallied, and now they have rallied more.
Pretty much because I think there's an underperformance in IT for the last 4 to 6 quarters, and people haven't been. So if you look at some of the bigger players, the mutual funds or the fund managers, they have gone underweight on IT in the last 4 to 6 months. We've been doing this for portfolio manager, and none of them had IT as one of the key top 5 sectors for them for the last 4 or 5 quarters there. And now it seems that it's time to call out the bottom. But if you speak to the TCS management, they were very cautious on it. They're saying that they still want to see 2 to 3 quarters of numbers before they can easily say that this sustainable growth can happen. So order flows are coming in. It may not be at the pace that they like, but that given the kind of headwinds which are there in the sector and globally what they're facing, it's not a bad growth rate which is there.
Yep, and in moments from now, we'll get in Rucha, our colleague, to try and tell us what is it that were the key standout features of the TCS commentary and the reportage, and some bit on the valuations as well. Remember, Sajid and Rucha spoke to the management earlier. Now, before we talk about the TCS numbers in detail, let's hear out what the management had to say in an exclusive conversation that K. Krithivasan, who is the CEO and MD, did with Sajid and Rucha. He, of course, said that TCS is expecting to do better in FY25 than FY24. Remember, Sajid and Rucha started by asking him about growth projections and plans. Listen in.
We keep tracking the kind of projects that we do, the kind of customer confidence in what they want to do, and what kind of projects get reprioritized. We still find some amount of volatility there. And we also seen instances where some of the projects have been paused at a shorter notice. So when that tendency reduces, right, when projects don't get paused at a shorter notice, or when reevaluation of long-standing project comes down, it will give us more confidence. But currently, customers continue to be evaluating projects, looking at which is the right place to invest. So as long as that investment with a stricter scrutiny continues at the same level, we have to be cautious. On a sequential growth basis, North America BFSI did better than what it did before. So to that extent, we are at least reasonably confident that that kind of growth can continue. It's a question of how much we are able to accelerate that growth. And even if you look at our TCV is, I don't think as a proportion of TCV changed, and also you don't look into the TCV on a quarterly basis because there is a inherent lumpiness, like which deal gets closed at what time. So that you have to look at over a period of 4 quarters to see whether there is any significant change. But we are confident about our BFSI. I would say we are playing on the front foot there. We are training almost all our associates to be generative AI ready. We created what we call an experience zone, where people can get in-depth expertise in these technologies. 3, then we announced Wisdom Next. Wisdom Next is a platform that helps our customers in adopting generative AI faster. Then we are also doing a couple of initiatives internally, like where you can do greenfield projects efficiently using generative AI. Then our industry groups are working with our customers in identifying use cases in the entire value chain where generative AI can bring in better products and services, so that there is a, otherwise if you look at only from a software engineering perspective, it's productivity gain. But you need to also see on the business outcome where you can increase the revenue and value for the customer satisfaction. We are working on those use cases as well. So we are quite deeply engaged with our customers. As we mentioned yesterday, we are close to having about 1.5 billion in terms of pipeline and about 270 programs that we are doing today.
Well, a lot of things that stood out. Let me first get in Rucha to talk about the highlights of the TCS numbers and commentary, and what is it that brokerages have had to say with regards to this. Rucha, good afternoon. What stood out in the results? What is it that was a standout commentary from brokerages? Because a lot of them hiked the target prices. Not everybody changed their ratings.
You're right, Neeraj. So TCS largely, if we talk about the numbers are largely flat. But you know what is happening right now, and why are the investors really happy? Because there's no negative in the company. I mean, no negative is also kind of positive. I think that is where investors are looking at. But TCS also mentioned that the demand environment remains unchanged on a sequential basis. But it also expects FY25 to be better than FY24. Me and Sajid, we also had a conversation with the CEO wherein he mentioned that there are no deal cancellations, which was the case in the fourth quarter, especially with TCS. But there's still some kind of deferrals, and the closing of deals is taking pretty long. Clients are also waiting for the US elections. When we spoke to him about the budget, he said that yes, clients are waiting for the US elections to come out, and then, you know, to have their budget in place, and then will they think about increasing their spending on IT. But I think the street is really happy today for IT, because there was no negative read-through for TCS. But we'll definitely wait for Infosys and HCL Tech to provide their guidance today.
Okay, now before we talk about the brokerages, and I have some thoughts here, but Sajid, very quickly, what stood out in terms of the commentary that you heard from Krithi?
A couple of things. One, there's no deal cancellations.
Cancellation.
Okay,
Right.
that's one thing which is there. But having said that, there's a transformation in the kind of deals which are coming in. Earlier, you used to have a large transformation deals. Those have slowed down a bit. But that's not a new form of phenomena. It's been happening for last 2 years or so. We saw huge transformation happening after the COVID, and many of them getting those deals, and now that deals are slowing down. Discretionary spends was something which was the key talk of the town maybe 8 quarters back. Discretionary has almost slowed down and paused. We then moved to a smaller deal sizes. Now what is happening is that smaller deal sizes are also under scrutiny. That's what Krithi is saying. So it is taking time is been taken for transformational deals and smaller deals which is coming in. But the thing is that now there is a generative AI has been spoken about a lot by the IT industry.
He spoke that I have what, $1.5 billion worth of deals in the pipeline.
Yes.
How different is it from Accenture actually getting the $900 million worth of orders?
So he's saying that none of the orders will entirely be based on AI. It will be AI will be a component of that.
Okay.
So for example, they got a Xerox deal that has an Office AI component in it, and that would be there. But whatever deals they are getting, even this 1.5 billion, all are sub 1 million deals. He said some deals are as small as $100,000. Those are the kind of deals which are coming. So it's basically experimentation which is happening on the street. The corporates are putting in that money to see what can be generated, what kind of gains they have before they make AI as part of their IT spend as a whole. The point from before it moves from a discretionary spend to cost of goods, which is essential for them to do it.
Right. Now, viewers, the other thing to keep in mind is that one of the other reasons why this could be welcomed so much, and this, remember, like I said, this is not just the first day of the rally. Since June 20th, we've seen these stocks gain quite a bit. We did a piece on Editor's Cut on the same as well. Amongst everything else, is the street viewing this as a turn of events? If it happens 2 quarters out, this is when the stocks start moving, because the market typically discounts things a couple of quarters before it actually happens. So could this be the start of that, is the key question, and therefore the kind of reward, because this is not ordinary trading purchases that have happened. This is institutional money that has gone into IT in the session today, because of which these stocks have started off higher and are staying higher. And I'll be really inclined to see the delivery percentages. They'll not be very high because the trading volume, I'm sure, is very high today. So the delivery percentages may not be very high, but be interesting to see. What this has also done, by the way, it's not just that IT service stocks have done well. Look at KPIT Tech. ER&D stock was not under any kind of a cloud or any kind of a problem, but look at the stock price movement of KPIT Tech in the session today. It's gained 7%, and at 1800 odd and a change, KPIT Tech 2 is trading at a new high. Can we get the stock price of KPIT Tech for you, please? You will see that even those stocks have made some CS. Sorry, I was wrong. It's not just 6%, it's 8.5%, nearly 9% for this one. So a lot of these stocks have moved. Now, Rucha, before we get in Sandeep Agarwal of Sovilio, one quick question of what brokerages have said. What are the standout comments from the variety of notes that we had?
Okay, so see, we inspected around, actually read around 10 odd notes from 10 brokerages. All of them have different views, but majority, I mean, maybe 6 or 7 of them have a buy rating. And the one particular note which I want to talk about is the Jefferies note, which upgraded the stock. So most of the brokerages have maintained whether there be a neutral standing or a buy recommendation, or even Citi, someone like Citi, which has a sell recommendation, have maintained that. But Jefferies have upgraded the stock to a buy recommendation. Now this is because it believes that there's return of growth in the key verticals like BFSI sector as well as North America. And another thing which is important for TCS is that we had a positive net addition during the quarter. Now this comes after a net headcount reduction over last 3 quarters, and mind you, this kind of number was at a 7-year high, 7-quarter high, 7-quarter high of net hiring. Now this can be a positive indication for uptick in demand, is what the brokerage house believes. And Neeraj, let me talk about the valuation aspect as well. Now the brokerage house believes that TCS is trading at 29% premium, which is like premium over the one standard deviation. Pardon me, one standard deviation below the 5-year, below the 5-year premium. But this is the kind of valuation which the brokerage house is really liking about the company, and this is the time to enter into the stock, is what the Jefferies is believing.
Just to add, you spoke about the delivery part of it. TCS 46% delivery as of now, and Infosys at 65% delivery.
Wow! Yeah, so on heightened volumes.
On heightened volumes. So there is a institutional buying which is happening, and as you said, the underweight part is now getting, either they're going to equal weight, or they're trying to push up positions ahead of the turnaround which is going to come in.
The other interesting thing, Rucha and Sajit, and we'll get in Sovilio in just moments from now, but the other interesting thing is, can this mark the beginning of upgrades for even the stocks on which the expectations are not that strong? HCL Tech comes out today. The expectation is that there will be a 2% downtick, right? Correct. And none of these companies, I mean, we can't now paint the IT companies with the same brush because one company gives hikes in a particular quarter. Our guest, Sandeep Agarwal, who's just joining us, was making this very important point yesterday, that the IT majors, the biggies as well, don't have a consistency in terms of that quarter 1 is good for all and quarter 4 is bad for all. Sometimes quarter 1 is good for TCS, may not be good for HCL. But quarter 2 may be very good for HCL. Depends a lot maybe on when they give the hikes, what are the kind of clients that they are winning. And yesterday, I remember this distinctly, and which is why it's great to have him today. He was amongst the few ones who said that it is not just the end of downgrades, it will be the start of upgrades for IT companies. And I think we've seen the first sign of that. Sandeep, fund manager and co-founder at Sovilio Investment Managers, joins us right now. Sandeep, I wish you were on the sell side, because I would have loved to see the headline of your note if you had written one today. But great call out there. What did you make of the TCS numbers and the commentary?
So, thanks for having me on the show, and good afternoon. So, it is good I am not in sell side anymore. I can give you frank views and opinions. But I have seen this industry for 23 years, out of which 3 years I have myself run a company unsuccessfully in AI and machine learning. And I can tell you this is very interesting industry and very, very complicated to understand because of 2 reasons. Simply one, it is a manpower driven industry, and it is a manpower factory basically. So you have to, deal with a lot of social qualitative aspect to run this business successfully and profitably rather than quantitative aspect. And very few companies actually has been able to do it. If you see across the globe, I don't think anyone has been successfully able to do it other than India. So as I said yesterday, I continue with that view that it is just a beginning of upgrade cycle. And honestly, in my view, stocks made bottom somewhere last quarter only. And this quarter, there is further run up. You will see another 2-3 quarters of run up. And by the time conviction comes to everyone, I think, the smart investor would have made 20-25%. And that is what this sector can actually offer you. That is the way I look at it, except ER&D, which is a very different story.
Sandeep, is the wage hike one of the triggers for the IT companies? Because if you look at TCS, you've seen that they came out with a wage hike which had an impact of 170 bips on the EBIT margins. But they are saying that they will be able to plow back most of the margins lost by the end of Q4. Also, the fact that it's a confidence that the management is showing in terms of while giving up wage hike, because while your environment may not be as conducive or it's it's a little hazy as I can say, but you're still willing to bet that okay, you need demand, there's going to be demand, and I'm going to spend on my manpower to to go through the entire order book that's going to come in.
So see, this is very natural in this industry. Every year in the wage hike quarter, you will have a one-time impact of 160-180 basis point, which pulls down your margin sequentially. And then over the period of the year, as your new resources keeps adding to your old resources, the average cost keeps coming down and your margins grow. So to give you example, last year, same quarter, TCS was at 23.5% and it ended at 24.7 now. So it is 120 basis point of recovery basically. So this year also, this is the way to look at it. We are at the bottom, 24.7. I will not be surprised if they end this year at 27.5 or 28. I will tell you two simple reasons for it. One, the attrition was 28% earlier. Now the attrition is 12%. And based on my practical experience of running tech company, I can tell you that 1% attrition means at least 30 basis point of less margin or cost, because there is a replacement cost, there is a hike which you have to give to new employee, and there is a lot of reimbursement which goes when you recruit a person. So if your attrition has gone down from 28 to 12, 16% attrition means 480 basis point of margin expansion in total should be happening. And that will automatically bring down your subcontracting cost, which was more than 10% last year. Now it has come down to 5%. So I think, both the things will help you to improve margins by 400 odd basis point, out of which I think 120 odd is already there. Another 250, 280 parents can recover from here if nothing goes wrong drastically, if there is no sudden spurt of demand, because in that case, again, these people are running very thin benches. They will again have to go and hunt for very scarce resources and give abnormal hikes to get them. So that is a scenario which happened post-COVID. I don't see now that should happen immediately, because honestly, I don't think that kind of growth is coming back of 20-25%. I think we are returning to normal growth part of 10-12%.
Thanks, Sandeep. Talking about margins over here, subcontracting cost has already bottomed out, and even utilization is at around 87% levels, and that is also peaked. So what kind of margin lever are you looking for TCS to achieve the 26 to 28% target which it has given?
So see, this is a wage hike quarter, right? So everything has come in one quarter. Now, as you see every quarter, there are some people who leave the organization, some people who join the organization. So generally the joining, you will see more joining comes from the fresher side or less than 3 years experience. So that cost is always less than the existing workforce. So that comes and, rationalize the cost. So that is one thing. Secondly, this subcontracting cost may have come down from last 4-quarter perspective, but if the growth is good and if they are able to maintain attrition at 12%, there will be further benefit. They will be able to further, shift subcons to mainstream, and that will further, there is a scope of 1.5% further reduction if the execution is good. But I think the bigger delta now will come from, one, the rationalization of wages over the next 3-4 quarters, and secondly, some growth will start coming. So if you see this quarter it was 4.4% constant currency year over year, it will move up to 6-7%. So the operating leverage also come into picture.
So Sandeep, let's therefore try and nail it down. I heard you say that ER&D is a different kettle of fish, so now I'm not bringing in ER&D right now. Yesterday, you were of the opinion that these stocks could actually give decent returns through the rest of the year. There has been a bit of a spurt today, but when we were looking at the delivery volumes, and the delivery percentages, There's seriously high delivery percentage today, which seems to suggest that there is institutional buying that has happened into the IT biggies in the session today. TCS has done remarkably well, but in fee about 4%, HCL Tech some bit, etc. Are these stocks good investment candidates even from the current valuations? For somebody who's missed your comments yesterday, is listening to you right now, what would you say?
I think still 8-10% comfortably is there. But you should not expect more than that, because see, they have already run up 10-12% from the last quarter, and they have run up 4-5%, 6% today. So another 8-10% is what I see. See, this sector, very simple, Neeraj, means it is such a monotonous sector. You have to take simple calculation, 2.5-3% global IT spend. Global sourcing is 4.5, 5, sometimes 6, and our market share gains lead us to 7-8. And these large companies do 8-10. So that is our steady state growth is 10% for large caps and 14% for the good quality mid caps, and ER&D is different. So for that, you can give 2 PEG ratio, 2.5 for the large ones. So 25 multiple is where they generally start feeling the pressure. And if 1 or 2 years there is less growth, the third year there will be high growth. It is as simple as that. You can postpone, but you cannot stop the spend. So it is the most, it is one industry where all the forecasting method could be actually shifted to AI very comfortably. Let me put it this way.
Well, that would be interesting, but it'll still be better to have you giving this forecast as opposed to AI doing that, Sandeep. Okay, I'll just make this one more question to you, because I heard you say yesterday, right, that all companies are different and different quarters are different for the different IT majors, large caps. I was looking at the 6-month performance. Tech Mahindra 15%, Infosys 15%, TCS about 7-8% in the last 6 months. Tech and HCL Tech just about 1.5%. So on a relative basis as well, some stocks have done really well in the last 6 months. Some like HCL Tech haven't. Is there a reason? Do you reckon maybe the underperformers could actually now perform as well?
So I will tell you one very interesting data about HCL Tech. It is the best performing large cap in last 15 years. Any period of time you take. So they have, 1, 2, 3 quarters, nothing will happen. In 1 quarter, they will cover all the underperformance and they will breach everyone's outperformance. Let me tell you. So it is that kind of company. The challenge and the reason is in their business mix, because they have ER&D also. They have everything which everyone is doing. So, they are mix of large, good quality mid caps. They are mix of small caps, and they are mix of large caps. So they do every work. And that is the reason, their performance generally comes in 1 or 2 quarters where everything comes together and they will have a rock solid quarter. And generally, because of their nature of business, they themselves are not able to predict quite well what will be the growth rate. So you will see whenever they have guided for 4-5% organic growth, they ended up 11-12% also. So I will say that, HCL Tech is very good bet. In my view, they have all the right ingredients. Tech Mahindra is very good again because their dependency on telecom has gone down drastically, and there is a new leadership. And in this business, B2B business, new leadership is everything. So I'm not saying, they will not post a good result or a bad result. But if someone wants to take a 2-3 year call, I think Tech Mahindra, HCL Tech will give good returns. And by good returns, I mean 15-20% CAGR.
Sandeep, the street is looking at a degrowth on HCL when it comes out today evening. What's your prediction for that?
See, I don't anymore forecast quarterly numbers, but let me tell you, the 2.5% kind of number which people are expecting, I will say that the right number to look at will be what is the services growth or degrowth rather than the overall number, because again, product is very cyclical and they have a good product piece. So I am not so negative, as I said, that if someone holds for 6 to 12 months, this stock can give good returns, because as rightly highlighted by Neeraj also, it has not done well for quite some time, and it generally always covers its underperformance over a period of 12 months. So initial 6 months could be bad, then it can do well. So some or other good surprise quarters will be there because their business is good fundamentally.
Thanks, Sandeep, for joining us and giving us those perspectives. Really appreciate your time. And with that, it's a wrap on this edition of The Big Story, which is the big IT comeback. Do let us know in the comment section what you thought of it.